Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and if you're new to this channel, then you can subscribe us by clicking the bell icon. Today we have a topic with us is leverage finance. When we talk about leverage is risk. Risk means debt. So risk doesn't mean debt. I mean, it's part of debt as a part of risk. So leverage finance is basically when you finance through leverage. So what leverage finance is all about, we'll try and discuss that. The first and the foremost thing that we are going to discuss is what is the leverage finance. See, leverage finance is described as funding a company or a business with more than normal proportion of the debt instead of equity or cash. So higher debt means higher financial obligation in the form of interest, or the what we call as fixed interest and principal repayment, and corporates have to fulfill their obligation irrespective of the profits to maintain its long-term solvency. So leverage finance directly impacts the cash flows and the net profit of the company and may lead to lower EPS also. Okay, dividend in the hands, or the dividend per share in the hands of the shareholders. So higher the financial fixed cost, that is what we are talking about here, the interest, are used to maximize the impact of the profit after tax for a given change in the EBIT, earning before interest and tax. Using more financial leverage, okay, within a capital structure may enhance some financial ratios of the company, like ROE, return on equity. Okay, now second that is what we are going to discuss is the leverage finance examples. Let's take a basic example to understand the concept of leverage finance. Okay, I'm going to take over here scenario one. Scenario one over here is you buy a company for, let's say, 100 million. You buy a company for 100 million for cash. So suppose there is an investment opportunity where you can buy the company for 100 million in cash, and your analysis shows that you can sell the company after 5 years for, let's say, 200 million dollars, and thereby you're making a handsome return of 2x, because from 100 to 200, it's what, 2x, right, in 5 years. So if you go and calculate, your IRR would somewhere will between in 15%, closely around, or 14%, because your purchase, let's say your purchase value is 1000 100 million dollars, right? In year one, let's say you receive nothing, zero. Same with year two, three, R&D. Let me just write 0 0 0 and 0. This is one, two, third year, and I'm going to take it to the fourth year. And in the final exit stage, you get $200. So our return multiple X is 2. This is going to be negative. So finally over here, let's calculate IRR. Our IRR, just try and values over here. So it's 15%. You see, I was close to that. So 15% is our IRR over here. Right. Now I'm going to take second scenario, scenario number 2. Now over here, let's say you take 50% in cash and 50% in D, that is debt financing. So let us now change the scenario and assume that the deal is financed by 50% cash and 50% debt, and selling price after 5 years is still 200 million. So here we will assume that the total payment of 5 million is made each year, and this 5 million consists of interest payments as well as principal payments or repayment. So at the end of the fifth year or 5 years, the total debt remaining is 39 million here. And when you sell the company at 200 million, the net amount that you may make is 200 million minus total debt remaining 39. 161 is what you make. So in the case of the IRR, comes out to be closely to, because it's going to be 50 debt, and yeah, so it's going to be closely to 20 or 19%. Okay, so one thing you might remember is that, in order to go for leverage finance, the predictable cash flows are very essential. You saw over here, right? And this is the reason why target companies are usually mature business that has proven themselves in the over the last years. Now, I'll make you understand what is the impact of the LF. Now, see, using high financial leverage in the capital structure of a company into the higher debt to equity ratio, and if in case a company is unable to generate that adequate cash from its operating activities, right, then it might default. It might default. And in repayment of its interest or principal amount that is due. Now, it will further dissolve the financial liquidity of the company in the run and raise in the short run and raise a question about its long-term financial solvency before the stakeholders. The bankruptcy of the company may come very soon without a chance and may occur in a difficult scenario. And the macroeconomic factors will also make the substantial impact on the leverage finance companies, and it may increase the chances of default, just like the recession in an economy will cut down the operation of the organization, and which leads to lesser income from the operation, and hence defaults and repayment of loans will happen and it will start. There were many corporate who defaulted worldwide in closely 2008, and everyone remembers that, of the financial crisis, and many of them declared as insolvent. Right. We have Lehman Brothers as one big example. So, what is the importance of leverage finance in investment banking? Well, leverage finance is one of the essential department of investment banking firms who help the corporate clients to provide leveraged loans for taking strategic decisions like acquiring a company, refinancing of its debt, expansion of the business operations. Okay. The leverage finance department is also responsible for planning, managing, structuring, and advising on the entire debt finance of the. So, the private equity firm, the PE firms, and the firms, they aggressively finance their customized project with the use of the high levered or the high leverage in their portfolio and enhance their returns. What are the leverage finance products? I'll quickly run you through that. We have first as leveraged loans. We all know what is loans, right? Then there is a high yield bonds. You can buy bonds. Then you have mezzanine financing. It is a short way of financing the companies with which are urgent need of money just to seize the best business opportunity. So it is a bridge between the short-term financing and the long-term financing, and it is mostly used by the SMEs company to easily finance a project in the cost-effective. Okay, so based on this, let me make my conclusions. While analyzing a company, leverage finance analyst needs to understand a company's use of leverage to evaluate its returns. Okay, and leverage finance will help to measure the risk appetite and also estimate the projected future cash flows and earning after tax. So, earning per share, EPS, returns on investments, leverage is directly related to the financial risk, beta, cost of equity, and which can be used to estimate the appropriate discount rate, which is known as your WACC, for measuring the present value of the company. So, using too much leverage finance can be dangerous for the firms unless it is properly planned and managed in the most effective way. So the amount of the financing leverage is usually it is deliberate choice of the management of the company, whereas the amount of the operating leverage, it is driven by the prevalent business model in each industries. So hence the corporate should set a limit, okay, on the use of the leverage in its capital structure as a part of the risk management activity. Okay, so that the stakeholders will not lose trust on the solvency of the company. However, the business with the means that can be used to collateralize borrowing may be able to use more financial leverage than a business that does not have any such characteristics. So that's it for this particular topic. I thank. If you have learned and liked the video, if you think that if you have enjoyed and learned watching this video, please like, comment on this video and subscribe to our channel for all the latest updates. Thank you everyone. Cheers.